Are you one of the many busy professionals working in offices day in and day out? Do you wonder how some people grow their wealth fast, retire early, and play on workdays? Well, you're in luck, because Ginny Bolling hosts this show, Pivot to Prosperity, where she interviews people that can do just that. Play on workdays. Many guests have become financially free. She also interviews people that are on their journey and people that are in support roles, like attorneys, contractors, brokers, and others. Commercial real estate is the common element. She is on a mission to be sure busy professionals know they can own substantial commercial properties too, like apartments, self-storage facilities, and others, and not have to do the work managing them. Passive investing is the key. Syndications are the typical method. Tax write-offs are some of the biggest rewards. Ginny and partners find the deals, build a strong team and business plan, then offer the investment opportunities to passive investors. New episodes are released every Tuesday at 12, so watch for new releases. If you want to get involved, let us know. You need to get pre-qualified to hear about most deals. See the show notes for contact information.
Hello there, Ginny Bolling here with Pivot to Prosperity, brought to you by Pivotal Real Estate Investments. And today we have with us Kaaren Hall.
Hey,
Kaaren,
hey, Jenny.
thanks for coming in. You have such a unique name. Have you ever met anybody else with your name?
I have not. My daughter was on an airplane and someone else was named Kaaren, which was weird. And one time I drove by a strip mall and there was like a Karen's dress shop spelled the same way. So it was a name. The name was never popular, but when it was a teeny popular, it was the 1940s. It was something my parents thought, since I'm Norwegian and they're Scandinavian, obviously. So, hence I am. They wanted to come up with an ethnic name. So I'm Kaaren.
That's it.
Yeah.
Glad to know what the reasoning is.
Yeah.
My poor kids, we started a tradition. My ex thought that his uncle had a middle name that was only a letter. So he wanted to do that with our daughter, the firstborn. And I was like, make sure that it doesn't stand for something. And he never did call. He never did check. So we gave her the middle initial K. And the going joke was she can say it stands for whatever she wants. But that's no period. That's her middle name.
The letter K. All right.
And to find out his stood for Keith. And
Oh,
so then we had to do it to my son. So his middle name is the letter G.
oh,
which-
that's funny. Yeah.
Anyway, but yeah, it
Never
wasn't
heard
a
that.
mistake for you anyway.
No. Very intentional. Yeah.
Well, you have quite the reputation. You travel in many of the circles that I do as well. We go and hit the conference circuit quite a bit and meet in these places where I'm usually in the circles of syndicators or investors of some sort or another. And you are often, almost all of the, most of the places I've gone, you've been a speaker, I would guess to say. And so you have proven yourself to be an authority in the world of investing in retirement vehicles, I guess I might be able to say. I'm going to pass you the mic with that since I'm reaching maybe there, but
Well, I mean, I'm an authority. I wrote the book. Okay, here we go. It's the
right, there we go.
BiggerPockets Guide to Self-Directed IRA Investing. And so this is available on Barnes and Noble and Amazon and all that. So yeah, this is a publication that came out this year.
That's terrific. So
Yeah.
it's recent, and we will put a link in the show notes for it.
Very good.
Yeah. So how did you get into this space?
I know. Like how did you get into self-directed? Like, how would you think of this? And I like to joke that when I was a little girl, I dreamed of self-directing IRAs, like it was my lifelong dream. But it's like one thing after another. So everything that I've ever done in my life is led up to this, and everything I've ever done, I use. It's like the foundation of the self-directed IRA industry. So I started off, my first career out of college was as a radio announcer for 17 years. So here I am on your podcast and I'm a speaker. That was helpful. And then I got into property management and I was a realtor for a year in my 20s. Then got into mortgage loan servicing for a while, for quite a few years. We used to call it cleaning up after the elephant. But it was account servicing, which is a lot of what we do here at uDirect, is we service the account. So I learned so much about that. Then I got into loan origination, coffee is for closers, that whole bit, and did that. It was really an education, learned a lot, and got out of that industry in the Great Recession. Basically it was, it was a mess. I don't have to tell you, anybody listening to us that was alive then or investing then knows. So that's when I got into the self-directed IRA space, because I couldn't, originate loans anymore since we're having a mortgage meltdown. So I was able to take all the skills that I'd acquired and use them in this space. And it was just a match made in heaven. I just took off right away. I was working for another company and doing great things. And then after a couple of years, I broke off and I opened my own company in 2009. And that is the genesis of uDirect IRA Services, 2009. And nobody knew what a self-directed IRA was then, And so, oh my gosh, Kaaren, what is this? What does this mean? Nobody understood the terms, and I was highly sought after. And it's like a lot of financial instruments, it's complicated. There are rules. It can get complicated. It can also be simple, but it's the same thing as a mortgage, really. Like a mortgage is a complicated financial instrument. If you think about it, lots of moving parts, but we kind of get it now. Anybody who's an investor pretty much gets a mortgage after you've been through that, and you've the trial by fire of getting a loan.
Yeah.
And you understand. Well, with self-directed IRAs, it's not that complicated, not as complicated as a mortgage, but there are a lot of rules and pitfalls and things to stay away from, but it's more well known. 16 years now into the future from the day that I started the company. But wow, what a great time to start this kind of company when no one knew about it. It was a great launching pad. And now, here we are, we have like over $1 billion, well over $1 billion under management now.
So that's amazing. That's
Yeah.
Mic drop.
Yeah.
But let me ask you then, during those years when people were not investing so much, well, some were investing in real estate, some were not. Was there a good market for growing? Was it easy to tell people about these self-directed and get them to understand at that point and to use them?
It really was. I mean, during 2009 again, we've had the great meltdown, and banks stopped lending, as you may recall.
Yep.
And so where were people going to find capital? That was the rush to the self-directed IRA space. You can have 10 properties, loans on 10 properties. Well, now you couldn't. I think they significantly reduced that number of properties that you could have a loan on. So investors were scrambling for capital. And then they realized that they could tap into what today is a $40 trillion pool of funds for their deals. So it wasn't just retirement savers finding these amazing deals on real estate. Remember buying houses on a tape where you just buy them sight unseen? There were so many houses and foreclosures, and that was how it was for a little bit. And it was such a great deal being able to buy houses with a retirement account. But at the same time, if you were, say, for example, buying a tract and you're raising capital for that, or you're building a multifamily, whatever you're doing to raise capital, banks weren't going to lend to you, but you could get the money privately. And so many times the self-directed IRA space has done that again and again to help rebuild Main Street. Because if you say, for example, Jenny, you've got a business and then say it's affected, especially like the strip malls. I feel bad for these people, but they every time there's a downturn, these families lose their businesses. And like my IRA could make a loan to them and to restart their business, and then they would pay my IRA back, the payment that we'd agreed on. So IRAs are really a grassroots level of getting capital to one another.
Yeah, you know what? I see too. I think that it probably helped to spur private equity in many other ways too. But
It did. Yeah.
why don't you give us like a list of all the things you can use
Yeah.
Self-directed for?
Sure. So it's the alternative asset space. And I don't know why it's alternative. It's basically it's putting a label on something that really doesn't belong there. What is more normal than a building? We humans have lived in buildings for millennia, but somehow it's alternative now because the powers that be want the stock market to be the normal thing, but buildings are somehow alternative. Well, this is changing though, and we'll talk about that later. But so the number one asset class for our industry is the syndication, the Reg A, B, C, D offering. And of course, that is the platform and the structure of the deal. But the underlying asset is almost always real estate. It could be like the beautiful multifamily building behind you. It could be, gosh, mobile home parks or self-storage, or it could be so many different real estate related asset classes, a strip mall. And so IRAs are heavily invested in those types of assets. Then
That's the
after
number
that,
one thing, really?
it is, yeah, for our whole
Wow.
industry. Yeah.
And I got to back up a little bit because you said it pretty quick. Reg A, B, C, D. The regulations you're referring to are the SEC, the Securities and Exchange Commission regulations, which govern us in one form or fashion or another, depending on the regulation. In some cases, we're exempt, but in any case, that's what that reference was. Yes.
That's right. Yeah. In order to raise capital on a large scale, you have to have the SEC's permission, as you know. And so you go to the SEC and you apply, and usually you talk to a syndication attorney and find out, well, what's the best for me for what I'm doing, my capital raise, what's the most appropriate for what my situation. And then you file with the SEC and you give them a lot of data, and then they ultimately hopefully approve your request to raise capital under the structure of this regulation.
Right, right. So I'm surprised to hear, but I'm glad to hear that it is that syndications are the number one, because I'm known for telling everybody that everyone should invest some of their money, their idle money, so to speak, in syndications, because they're so successful if you choose them right, of course.
If you choose them right.
But yeah, they can help people so much. So yeah, that's
Really
interesting.
true.
So what's
Yeah.
number 2, 3, 4, and the rest?
Yeah, well, 2 is notes. Like I mentioned, that you could lend money to a business. You can lend money, secured or unsecured. So your IRA can loan money to people and be the bank. Now, there are rules, there are prohibited transactions. So some people are prohibited, or disallowed, like your ascendants and descendants. So parents and grandparents, you and your spouse, your children and your grandchildren, disallowed. So your IRA does not lend money to them. Your IRA doesn't buy an asset from them. Your IRA doesn't give money to them, or for an investment. These people are disallowed, and they don't do business with the retirement account. Now, also disallowed is a fiduciary, like a realtor or maybe your CPA or something like that, fiduciary to the plan. And also a 50-50 business partner is also a disallowed party, because they're too close, they're too closely held. So there are people who are disallowed who your IRA cannot do business with. So one of our biggest jobs here at uDirect is helping people avoid what we call a prohibited transaction. And one prohibited transaction is doing business with a disallowed person. And so I do a lot of education. That's why I speak often, is to help people understand not just the power of their retirement to invest, not just in the stock market, but also what the rules are. And so that if you're going to win the game, you have to play by the rules. So what are these rules? How do I win? And I do a lot of speeches and talks about that.
So when you're talking about those people that they cannot do business with, does it make sense when you say that it would appear that you're self-dealing then? Is that a key phrase? Isn't that where it comes up?
Well, it's part of it. Yeah. So you're disallowed to your IRA. So self-dealing would be if you received personal benefit from your IRA owned investment. For example, people are people, not everybody gets this, but maybe like a GP, a general partner raising capital, might think that, oh, I'm going to put my IRA in this. I'm going to invest my retirement dollars in my fund. Well, you can't. It's self-dealing, but it's more than that. It's 2 prohibited transactions. Number 1, it's receiving personal benefit. And number 2, it's what we call offering services to the plan. Because as the GP, you're making all those decisions, and you're getting paid for it, and it's a mess. GPs do not put their retirement dollars in their own deals. Because that would be so, like, prohibited transaction. What's so bad about that? It doesn't sound so bad, right? But it is. So what happens is that your IRA, all the assets in the IRA, it just blows up. And now the value of all those assets becomes taxable to you. You get a 1099 and have to pay income taxes on all that. Plus, it's backdated to the date of the infraction for penalties. It's just a giant financial mess. So I think one of our biggest jobs at uDirect is steering people clear of prohibited transactions.
That's great. Yeah, that's important because I hear it every day. I serve on the board for our local REIA, and we have like 15 meetings a month, and constantly new people are coming in, and they're hearing tidbits and thinking they can do this stuff. And yes, that's critical too.
I mean, we have so much freedom with our personal cash. We can do this and that, and there aren't these restrictions. But because these accounts are tax-free or tax-deferred, then the government gets to say, if we're going to give you this tax benefit, you have to follow our rules.
Yeah.
And these are the rules. So not everyone is proficient in them. But you know what? There is a book that tells you. I'm not going to.
Yeah. The other thing I say too is remember retirement's for later. So you can't benefit now.
Correct.
So remember, pause off, right?
Yeah, pause off. Yeah. No, we have to save for our future. My gosh. I mean, who's ready to retire? Like if you had to retire right now, then you think, whoa, like all of a sudden, some door shuts and you're like, okay, now I'm retired. You just have to ask yourself that question. I think if it happened today, would I be ready? And wow, if the answer is no, which it is for like 99% of people, I think, then what do you need to do to get from here to there? And self-directed IRAs are one of many paths to answering that question.
For sure. We're going to get into some of that too, but perfect segue for you to say what your takeaway is. If nothing else, you want people to take this away. What is it?
If nothing else, write yourself a check to your IRA because you've got contribution limits. So talk to your tax advisor, say I have, or if you don't have an IRA, open one and contribute to it. Talk to your tax professional. Say, look, of course, we've just passed tax season, but we always know that the next tax season is just, it's right on our heels. So just ask your tax professional, hey, what's the best kind of retirement account for me? I'm self-employed or I have a W-2 job, or explain your situation, and then max out your contribution. Write a check to yourself. And my CPA, her favorite expression is pay yourself instead of the IRS, because a lot of times when you make a contribution to a retirement account, you can get a deduction, right? So pay yourself and save for your own future. Gosh, if you can save for your own future and get a tax break now, why would you not do that? It's just a win-win. So that's my takeaway. Help yourself, Team you, go.
Good. All right. Well, and talk about some of the different types of accounts that people can open.
Yes. IRAs, there's a traditional, which is most common. A traditional IRA has a contribution limit of $7,000 if you're under 50, 8,000 if you're 50 plus. Now this changes annually, these numbers. Okay. So it'll be more for 2026. Okay. But that's how it is. A traditional is the most common. It's a pre-tax account. You make a contribution. If you don't earn too much money to qualify, then you get a tax break. Now, a Roth IRA is the second most common, and you contribute after-tax dollars, but then any investing proceeds grow tax-free for life. As long as you've had a Roth for 5 years and you're 59 and a half. After you meet those criteria, that money's tax-free to you. And then after that, we have the SEP, a simplified employee pension for self-employed people, a simple IRA, which of course isn't simple because, that's what it's called. It's a savings incentive match plan for employers. It's an acronym. And they're not very popular because the SEP is so much better. There's a solo 401k you can self-direct. Also an HSA, a health savings account. And plus there's an IRA called a spousal IRA. It's not a special kind of account. It just says that, like, in order to contribute to an IRA, you have to have earned income. But if you are the spouse of an employed person, you don't work because you're home, working at home, you can have a spousal IRA and still contribute to it, even if you don't make money, because your spouse does. And that's what we call a spousal IRA. So those are the kinds of accounts that people utilize and self-direct.
They're all self-directed.
They can be.
All can be. Yeah.
So I should explain that an IRA is an IRA. I mean, these were created 50 years ago when Gerald Ford signed the ERISA law into effect, right? And so an IRA has always been one thing. It's an IRA, it's an account, and it started in 1975. But the difference is what kind of asset class are you going to invest in? Market assets or non-correlated assets, alternative assets. So a self-directed IRA is an alternative assets.
And were we recording it when you talked about the 50th birthday? I don't think so.
I don't think so. No, yeah, it's this year is the 50th anniversary of the IRA. We have an industry group. It's called REITA, the Retirement Industry Trust Association. And when we had our spring conference, we all got little cupcakes with 50 on it. We said we had a birthday party for the IRA. So yeah,
That's
it's 50
great.
years. Yeah, 50 years, longer than most of your audience has been alive.
So yes, a lot of people, especially our younger folks, go to work and get an employer telling them what they should do. Some HR person says you should open one of these accounts and there's matching up to whatever. And the kids don't know anything beyond that really, pretty much, right?
A
So
lot of times that's true, unless you independently go about and do your own research. But I think we're all busy at that stage of life doing our jobs and learning our jobs and kind of figuring out life. And retirement seems so far away, but it just isn't. Life is short,
right.
And so it seems so far, I don't need to worry about that now. So you just leave it, set it and forget it.
Yep.
You're not even thinking about it, but you need to think about it because that is your future wealth and your future retirement, comfort and lifestyle.
And I think what's happened is over the years, there's been so many people in those shoes and especially people our age that, we think that that's the only choices. It's not until something like Rich Dad, Poor Dad or something that, that book or somebody
Mhm.
shakes you and says, this is what I'm doing, right? Or wakes you up to it. But
Yeah.
so I think it's critical that the younger people and everybody actually find out about this, and there may be a way that they're going to have this awakening, right, with the new legislation that's been proposed. You want to talk on that?
Yeah. This is not just proposed, but it passed with the big beautiful bill. So this is called, well, it's not called anything yet, but it is what it is it's the big beautiful bill allows for basically what will be alternative asset funds in employer plans. So it's not like your 401k being able to self-direct like an IRA can. It's going to be that your employer plan can invest in a fund like a sleeve of assets. We were calling it that today on a call, a sleeve of assets that are alternative, maybe for like some syndications or something like this. But it's not investing in the individual asset, it's investing in a fund that has invested in these assets. So that is something new. It's bringing the alternatives into the mainframe, a little more into the nomenclature of retirement savers. Yay, that's great. And maybe we won't be alternative assets anymore. It'll just be assets. We'll come up with a better name for it because it's really important to diversify.
Yes.
And just like you say, I mean, an IRA or 401k is just not going to cut it at all. So one thing I like to talk about is this because I had to figure this out for myself. So, okay, I'm going to retire. How am I going to do this? So, well, where's the money going to come from? It's like, well, okay, maybe there's Social Security, bottom of the barrel. I worked at a job one time and have a tiny annuity. So I have that, a little one from somewhere I used to work. Well, what else do I have? Well, oh, guess what? I have life insurance. I have life insurance with cash value. That's cool. And I have some, insurance products. Okay, because I've been like listening to my financial advisor and doing what she says. So I have market correlated assets. But I mean, then what else do we have on top of that? We've got our retirement accounts, don't we? Self-directed accounts, employer plans for retirement. Then we have our personal assets that we've invested in personally. Maybe you've bought some single family homes. Maybe you've personally invested like outside of your retirement account into a syndication or some other kind of asset. So the assets that we invested in personally, then we have just our cash savings. So there are probably, I know that there are a lot more different assets. And then when you've got all these assets, the second step is to have really great tax planning. So you keep that. And then another step is to have a really great attorney who's helping you with asset protection so that you again keep that and that you're able to pass it down to future generations. So there are layers to getting ready for retirement. And the self-directed IRA is one of those layers.
Does your book get into all this?
It kind of it touches on it. Yeah, it does. It does. It
Good.
also talks about the history of retirement, because retirement itself isn't biblical, which is, let's go back 2000 years. Did people retire? No, you worked till you died. There was no such thing as retirement. But since, modern times, 1900s, we started this idea, I think, of the gold watch and retirement and all these things. So, but I don't think people always want to have a sense of purpose. We have to have a sense of purpose and to be able to give something back that's worthwhile. But if we do choose to, hey, guess what? I've got another plan. I've got this thing I want to go do. I'm going to go volunteer over here. I'm going to go do this project over there, and I'm not going to, WORK anymore. And you can do that if you've saved. And so what a self-directed IRA does is help you. It helps you to find the assets that can, build this portfolio, so you can go do that.
Most definitely. And as far as the number of accounts your normal client has, is there more than one?
A lot of times people will open a traditional and a Roth.
Mhm.
That's really common because they'll open a traditional and contribute to it, and then do a conversion to a Roth. It's called a backdoor Roth. If you make too much money to contribute to a Roth because there are income caps, you can contribute to a traditional and then convert annually. And so when you do a conversion from a traditional to a Roth, it's a dollar for dollar taxable event. So say, for example, you contribute, say, $7,000 to a traditional IRA, then you convert $7,000 to Roth, you will be taxed and get a 1099 for $7,000. But that is a common way to work it, to work the system. Then those dollars grow. You pay the tax now, you don't pay it later.
Yep, it's a good thing to do. And it's funny, there's also a book out there, something about zero tax. Forgot what it is, but yeah, I was thinking should convert everything to a Roth, but they were saying no, really, you should keep some in an IRA as well too. So it was interesting to hear the balance. But so okay, we've talked about all the different types of accounts. And so if we were talking, like from my case, where I'm a syndicator and I'm trying to help counsel people on how they can make decisions about how to invest, whether it be they have personal money or retirement money, what kinds of things would you recommend that the conversation covers?
Right. So a syndicator raising capital, and this is the big question. Wow, where do I find capital? How do I raise capital? And there's events you can go to that teach you about raising capital. But with a self-directed IRA, it's a very simple question. You tell somebody about your deal, and then you say, do you have an IRA or do you have a 401k with a previous employer? And if they say yes to that, they can invest in your deal. They may not even realize, like, my IRA can't invest in a building. It's an IRA. I can't do that. I can only invest in the stock market. A lot of people don't know.
Right. Right. And so when you start talking about that syndication is going to take on a mortgage for say 70%,
Oh,
then what conversation do you feel needs to
yeah.
occur?
Well, this is the thing. If you're going to be an investor, then you have to be somebody who knows how to do due diligence. And due diligence is about asking questions. So if you're going to take your IRA and invest in a syndication, if you're looking to do your due diligence, you're going to ask the asset sponsor, the syndicator, are you taking on debt in this fund? Because, or whatever, this project. If debt is part of the capital stack, and if part of the proceeds are that your IRA receives are earned because of this debt, it's going to throw off a tax to the IRA. People, that's surprising. It's not an income tax, okay? Because these accounts are income tax free, income tax deferred. There are two taxes. They're twins, really, called UBIT, unrelated business income tax, and UDFI, unrelated debt financed income tax. So your IRA can invest in a syndication as a debt partner. Your IRA can make a loan to the deal, and there's no tax. There's no UDFI tax, okay? But if your IRA invests as an equity partner in the deal, and there's debt in that structure, then the portion that your IRA earned because of debt, not the whole thing, but the portion, the percentage, will be subject to this UDFI tax. This is why, again, as an investor, you've got to have a great team of professionals, like tax professionals and legal professionals to review your deals, set up your asset protection, and tax people to help you set up these things and let you know, where you stand and to maximize your position.
Exactly. And as far as actually computing what that tax would be, do you know how to explain how to figure that, or is it too complex for different
Well, I
scenarios?
don't give tax advice. We're not
Right.
advisory.
Yeah.
But what I'll tell you is this. This is where you can find it. You can look up irs.gov, IRS's website. Wow, it's actually great. If you need to find out information, it's not written in hieroglyphics. You can actually read it, and it's interesting and it's well written. So IRS.gov publication 598 discusses these taxes. Okay, publication 598 at IRS.gov. And then talk to your tax person. Say, hey, have you ever filed a 990T? Like you and I, when we do our taxes, we do a 1040. The IRA files a 990T. So you want to first ask them, do they even know what a 990T is? You want them to say yes. If they don't, you might need a different tax professional that's understands your level of investing. So that would be a good due diligence thing to do. You do your homework first, right? But you can take deductions. And so, what's deductible, your tax person will know. So it could be possible, even in a situation where your IRA is invested in a syndication, there was debt, it's possible your IRA could owe no UDFI tax because of write-offs. That is possible. But again, it's a conversation with your tax professional.
Right, right.
And you want them to know anyway, because they're the ones that are going to determine what that bottom line number is, and are you getting a refund, that sort of thing.
And you certainly want to do it because you don't want to alienate your investor, because if you don't tell them about these things, then they're going to be upset when they find out, and it's tax time if that's not already understood, right?
A lot of times, when you invest in a syndication, as you know, of course, you have an operating agreement, and then you have the subscription docs. And so the operating agreement should, but does not always describe, hey, guess what? We're taking on debt. And if you have an IRA there, you could be facing UDFI tax. Yep. That is not always disclosed. So you must ask as an investor. That's part of your due diligence.
Right. Good. Well, and so you'd mentioned previously you could do a debt a loan instead. Now, if you've got a lender and they're underwriting the deal, I imagine they may have a threshold of where that makes no significance, but if you're giving like millions, maybe you have to be underwritten too, right? Or
if you're coming in as your IRA is coming in as a major player in the deal, because we call it de minimis. Normally an IRA is just a teeny little thing, it's not significant. But of course, so if you're the asset sponsor, you've got this big loan and you're taking on other debt that would normally, I would assume, be subordinate to the major chunk of funds there. Yeah, you definitely have to make sure that your lender is okay with that. Yes, and there are a lot of questions. This is where you've got your syndicator, you've got your lawyer, they're setting it up for you. So you set it up. And so some people will have like a debt fund where or they'll have a fund of funds where they're just raising capital. So there are a lot of ways to structure things.
We've gotten into that much more, the fund of funds. It's much more compliant and flexible these days. The industry, as you know, is evolving. Yeah. So yes, we've gotten into that more and more. I wanted to make sure we still have time. We're wrapping it up, but what's going on in the world of fraud for you guys? Because I know it's gotten terrible in many places. Is there any words of wisdom you want to share?
Yeah, I mentioned our industry, REITA, Retirement Industry Trust Association. So I'm the fraud fighter for REITA. And
you are?
I usually lead the fraud panel. I mean, fraud it's always been around. I think since money has existed, there's been someone trying to take it from you. So don't just think that just because they're so nice, and I'll tell you, honestly, I invested with somebody who is so nice. I did. And I think, I'm just like, I'm too smart to be fooled. No one's too smart to be fooled. So I invested with somebody who is in this local community of investors. And that person decided to move to another country and not pay their investors. But guess what? I am just about to get a check for 100% of my principal back. That doesn't usually happen. But we, as a group, talked to them and had a legal situation going on. It was a group of us, and we're getting our money back. So who knew? And because it was real estate, there was appreciation in the asset. And so the lawyers get paid and we got our money back. So very happy about that. Doesn't usually happen. So it doesn't matter how smart you think you are, because fraudsters can be smarter than you think. And if you're not evil, you might not even think of evil things. So, but just do your due diligence. Look at the track record of the person. For Pete's sakes, at very least, Google them. We had this one account holder if she would have Googled the people she was investing with, she would have seen that one of these two guys was literally jailed for 2 years for stealing money from people, incarcerated. And she went ahead and she tried to invest with it. We saw it. And so we're not the police, we're not the FBI, we're not the fraud fighter, but we saw it. So we said, this asset is not administratively feasible. That's what we could say, because
That's all you could say?
that's all we could say. Oh,
Huh.
that was fun. Yeah, that was fun. Telling the asset sponsor who's screaming at me, but you said, it's like, yeah, but we're not going to fund your deal, buddy. So yeah, good luck. And it's a long story, but yeah, just so you want to do your homework. How do you do your homework? We could do another hour on just due diligence. So many YouTube videos. You want to talk to your asset sponsor. You want to ask them about, after the deal closes, after they have their money, what kind of scrutiny can you do, or will they provide audited financials after the deal? I mean, but even Bernie Madoff had his books reviewed by the SEC. They came in and looked at his stuff and said he was okay. So I'm saying that investing is risky. That's why sometimes you have to be an accredited investor. Don't mean to scare you away, but I do mean to make everyone cautious and not just think, well, they're so nice, and believe me, that's how a lot of investing happens. They're so nice, and I'm just going to do this. And because it's trust, but verify.
Right. Okay. Now, lastly, if somebody's ready to make a move, they want to move some of their money. I think you were real clear in the past. You're not withdrawing it. You're moving it, right?
Oh, yes. No, it's, yeah.
Walk that through.
Yeah. When your IRA buys, for example, when your IRA invests in a mutual fund, you're not withdrawing the money, taking it personally, and then investing in the mutual fund. That mutual fund is just an asset that the plan acquires, right? And so the same thing with an alternative asset. You don't withdraw the money and acquire the alternative asset. In fact, if you did that, that would be a prohibited transaction because the money would become personal and taxable to you. And then if you invested in something, you would own it personally, so you couldn't put it in the IRA, all right? So it's your IRA acquiring an asset, whether it would be a stock market related or alternative asset. So the IRA buys the asset. The buyer, the investor, is the IRA, not you personally, not just your personal name. Your personal name will be in the titling, but it's not you, the human. It's the IRA account that's the investor. And that's how you do it. So it's definitely not a withdrawal, not taxable to invest. The part that's taxable is taking personal use of the money.
Right. And to that end, just to repeat a bit more than of what we said before, if you buy a property, a rental property, say, in your IRA, you can't be the one renovating. You've got to hire everything out. You cannot be self-dealing and making it so that you're
Right.
hands-on, right?
Right. Well, so you don't swing the hammers, you don't, whatever, you stay arm's length, but you can do some things. You can do some things. You can kind of property manage, but number one, you could never take a fee for being a property manager of your own IRA property, because then you'd be getting personal benefit from your IRA owned asset, right? But what you can do is you can obviously choose the property, you can screen the tenants, you can hire third-party vendors to do the work, and you can pick up the rent check that's made payable. Well, of course, we don't pick up checks anymore, but just hypothetically, you could direct the people where to ACH the money, or if it was a check, you could pick up that check and send it into your IRA to be deposited there. So you can do these things and property manage in that way. But again, right, when it comes to repairs, renovation, anything like that, you just stay arm's length.
Great. Okay. And lastly, one thing that you were saying that you'd rather be recording it was, once somebody puts the money in, they've got to be looking for a place to invest. So while they're waiting, is the money idle, or how do you handle that?
It is. So it's 3 steps really. You open an account, you get the money in there, and then you invest. And the reason you do it in that order is because when you find an asset, a lot of times most people they have their asset already, and they want to jump into it. If you want to invest in real estate, you need the money there to make the earnest money deposit too. The money needs to be there. But you open it up, get it funded, and then invest. Now, all expenses of the IRA owned assets are paid for by the IRA. So I mean, this is a thing of the past, I hope, but people were getting capital. People who invested in multifamily in 2022 started seeing capital calls in when rates went up. Now, this is something that happened in the past, but those people had to come up with these capital calls, normally thousands of dollars, from their IRA funds. Had to be IRA money. And that's the money that's sitting there in the IRA account where it's uninvested cash, right? And that's what it's for. If your IRA owned a house and the house needed a new roof, your IRA has to pay for that new roof. You would never pay for it yourself. You'd be benefiting the plan. It would be prohibited. So,
Right.
so you definitely need money. If you have a note and then the borrower isn't paying and you need to have that loan serviced, you need somebody to go after them in debt collection. Your IRA would pay for someone to do the debt collection if you wanted to go official like that.
Got it. Okay. All right. So, and like we ask everybody towards the end here, is there a pivotal person or event that's happened in your life or affected you? Or is there something that you're striving towards that it'd be pivotal?
Yeah, I think a pivotal person in my life is my CPA, Amanda Hahn. She and I, we opened our businesses at the same time and we in the same executive suites. And she has done my taxes just under 20 years in a row. And she's helped me so much to understand what I'm doing. She's so patient with me. Her staff is patient with me. Yay. And so she's been pivotal in so many ways and just helping me understand the tax code. And now she's grown quite a large following for herself because she's so good at what she does. So I'm really lucky to count her as a friend and as one of my primary advisors.
How do you spell her last name? Is it H-A-N?
H-A-N, yeah, Amanda Hahn, H-A-N, and her husband, Matt McFarland.
Oh,
And
okay.
their company is Keystone CPA, and they're just really wonderful.
All right. Well, so now what happens is you can tell her you nominated her, or I can call and say that you nominated her. And
Yes,
if she comes on the show, she
yes,
will be promoted as a pivotal person and
yes.
get a lapel pin that says that. And we'd love to have her on. So do you want me to call her or you?
Well, we'll talk about that offline. I'll
That
give
up? Okay.
you got the
Very good.
details, but she's definitely a pivotal person in my life for sure. And
Nice.
people's
Well,
lives.
and I'm always asked about, do I have any CPAs I can recommend?
Yeah.
So that was something I was thinking I should ask you anyway. So I'm glad you said that. All right. So tell people how they can reach you.
Yeah, the best way is here is my logo, uDirectIRA.com. So uDirect, we're on all social media channels. So you can find us there. If you want to learn more, because I do little shorts about IRA rules, and there are a lot of tiny rules. We didn't cover even half them today. So there's a lot to know. So I have, social media platforms, but the best thing to do really is to, call us or email us, info at the letter U, uDirectIRA.com. Info at uDirectIRA.com.
Great.
And then set up a consultation. We do a free 20-minute consultation. We want to talk to you, tell us about your deal. We're going to listen. Hey, is this a prohibited transaction or how can we help you? And we'd love to help you out.
Great. Yeah, we need a lot more people diversifying off of Wall Street too, because it's getting so heated up.
Yeah, yeah.
But great. Well, and we'll put all this, all of that information into the show notes, as well as a link to your book. And congratulations again on publishing.
Thank
So,
you.
thank you again.